Hello and good afternoon, everyone. My name is Sarah Bickers. I work at IT Credit Union. We're becoming Wings Credit Union in the Financial Education Department. I've been on the team here at IT for a little over 4 years now, teaching financial wellness presentations like this one. Today, we are going to be going through Borrow with Confidence, Understanding Credit and Debt, and we're excited to share this information with you. In today's presentation, we will be talking about the importance of credit, how to manage your score, and prepared borrowing. If you have any questions that you would like to ask us throughout this presentation, you may type them in the chat or in the Q&A, and I will answer them at the end. The first thing that we would like to define is what is credit? What are we talking about when we talk about credit? When we're talking about credit, we're referring to the ability to access money, goods, or services now with a promise to pay later. Oftentimes, we see these in different forms, like loans from a financial institution, using a credit card, receiving a service, and paying later. It's important to note that how you manage credit builds trust and impacts your future opportunities. Typically, when we are talking about credit, we're referring to situations where you have borrowed money with that promise to pay it back in the future. It's also important to note different types of credit you might see. For example, secured versus unsecured credit. With secured credit, it's backed by collateral, so something that you own, an asset that you are putting down that can be taken if it's not repaid. With secured credit, you typically see lower interest rates out there tied to that product or tied to that loan, because if you don't pay that secured product, then they can take that collateral or that asset that's associated with it. So the interest rates, those fees that you pay on the product may be lower. Unsecured credit has no collateral required. These are things like credit cards or maybe student loans, and they're based on your credit worthiness. So your history of credit, as we'll talk about with your credit score, will really influence your approval for unsecured products. It influences your approval for secured products as well. But with unsecured products, there's no collateral, no assets tied to this product, nothing that can be taken if you don't pay those. And because of that, we typically see higher interest rates or higher fees associated with those products, because if you don't pay those, it's a little riskier for the financial institution that's lending. So you'll see higher interest rates tied to unsecured loans or credit cards. The next thing that we really want to define is that credit score piece, that number that you and financial service providers and other service providers will see when looking at your credit score. So they'll see this number. We'll talk about the range here in a second, and it really helps inform them how likely you are to repay what you borrow. So higher credit scores, higher numbers show that you're more likely to repay money you borrow based on your behavior in the past, while lower numbers make it seem like you might be less likely to pay the money that you borrow because of many different factors that could have happened. In other words, higher credit scores open up more opportunities and better options, especially when we're looking at scenarios where you may be borrowing money. Now that we've talked about defining the score, we want to talk about who might check this credit score. There are a lot of different institutions and service providers that might check our credit score. The lenders, so folks that are letting us borrow money, especially want to know how likely you are to pay that money back. So they're going to check your credit score to inform them of that scenario. But all these other organizations may check your credit score as well, from internet providers to utility companies, insurance companies, landlords, cell phone companies, and employers and security clearances for the military as well. When these other organizations check your score, they may be asking how likely is this person going to keep to the financial contract they're entering into. So things for like utility and internet providers, they're really wondering, is this person going to pay, and are they going to pay as agreed? So that's one of the reasons why they might check your credit score, and it might influence the deposits you may need to put down for some of these products. Insurance companies might check your credit score because studies have shown that folks with lower credit scores tend to file more claims on insurance, so you may get charged a higher premium for your insurance if you have a lower credit score. And employers may check your credit score, especially if you're working in the financial field and there's a part of your job that's related to credit reliability. So they may check your credit score as well. In other words, credit impacts a lot of areas of our life beyond just the money that we're borrowing. When we're looking to check our credit score, there are many different places we may go, but we have one resource to share with you all that can access checking your credit score for free. So you can go to int.com/yourcredit or scan that QR code there and access our partner site Savvy Money for free when you use our site. When you're looking at your credit score, you are seeing again that number that represents that risk scenario for a potential lender or other groups, but not your worth. And the goal is to have access and not necessarily perfection. Note that your score can change and you can influence it. When you see your score, you'll typically see your score fall in this range of 300 to 850. This is the standard FICO score range. And the higher the score, generally speaking, the more likely you're going to get approved for products. You're going to get better interest rates. It opens up more doors, as we might say. The big threshold here with the FICO score range especially is the 740 and up threshold. At 740 and up, you have very good to exceptional credit. You're very likely to get approved for anything reasonable you're applying for and get the best interest rates on that product. If you find yourself lower on this scale, you may face more challenges, might have to pay higher interest rates, may get told no for certain products and certain things. It can impact many areas of your life, as we talked about, but that doesn't mean that you're stuck in that part of the range. As we said, it can change and you can influence it. And here in a second, we'll share some tips that you can use to work to build your score up higher. With our website, int.com/yourcredit, you will see your credit report and score. I'll talk about reports more here in a second. Your letter grade breakdown. So it's going to give you like a report card style feedback for all of the different areas of your credit score that we'll talk about, and personalized advice on what you specifically can do to work toward your credit score goals and building up your credit score. Again, if you access it through int.com/yourcredit, you'll get that Partner Savvy Money credit score checking tool for free. I mentioned we'll have another resource to check your report. So your credit score is that number that institutions see that represent how you manage credit in the past and all these other factors we'll talk about here in a second. But your report is really the list of information that lenders and anyone seeing your credit report may also see that can influence them of the why behind that score, of the different scenarios that might have led to it, and things to keep in mind. It's really that list of all of the information that is reported from your creditors to the credit bureaus, so different organizations that collect credit information, which are TransUnion, Equifax, and Experian. When you're checking your credit report, you're really looking to see what information that potential lender or other service provider is seeing, and you're double checking, is this information correct? If there's any information you see on your credit report that might not be correct, it isn't something that you did, that could be a sign that somebody has stolen your identity and has been accessing your credit, and that's something that you would want to report and take action there. So when you look at your credit report, you can go to annualcreditreport.com. That's the only government authorized website to check your credit report. And you can access one free credit report per week from each of the three bureaus. So TransUnion, Equifax, and Experian. You'll enter your personal information, pull those credit reports, check all that information is correct. But your credit reports don't show your score, which is why having another tool like our partner Savvy Money and going to int.com/yourcredit can be really helpful in seeing that credit score, and then checking your report as well can be an important part of your overall financial health. After you've checked your score and looked at your report, you may want to know, what are the factors going on here? What's really influencing my credit? Typically speaking, there are 5 areas that influence your credit score. It's your payment history, your utilization, your length of credit, your mix of credit, and new credit. The biggest factor that influences your credit score is that payment history at 35%. This really comes down to, are you making payments on credit cards, on loans, on your credit products, and are you making them on time? If you're in a scenario where you may be a little late for paying that product, like a few days, it's not going to impact your credit score just yet. It is reported to the credit bureaus that you have a late payment after it's 30 days delinquent. So if your payment is due on the 1st, you have 30 days to work something out and get that payment in before it reports to the credit bureaus and impacts your score. But since payment history is the biggest factor that's influencing our credit score, we want to do the best we can to make our payments, especially for those credit cards and those loans, make them on time. The next piece is that utilization piece. Utilization refers to how much of a balance you have reported, typically on revolving credit, so things like credit cards that you're using, and that's reported to the bureaus. The general idea with utilization is that we don't want to have really high balances on our credit cards reported to the credit bureaus. They may ask, why is this person not paying off their credit cards? Is there something going on here? And since credit cards are money we borrow, paying them down, paying them off can be a good thing. And it's one way to build credit for free. So to pay off those cards, ideally in full, perhaps a little early. But if you're ever worried about this utilization part of the scenario, you can double check to see when your creditor is reporting your balance to the bureaus and work to pay down your utilization, so the amount that you've used on your credit card, to under 30% of your available credit, and that can help boost your score. The next piece of this is length of credit. Length of credit doesn't matter as much as things like utilization and payment history, but it really just has to do with how much data the credit model has to pull from. The more data, especially when it's good, that it has to pull from, the more it can help your credit score. So there's just more information to show that history of managing credit well. One tip here is to not close your oldest credit card unless there's some extenuating circumstance going on, because that credit card can build out your credit history for a really long time. The next two, mix of credit and new credit, both come in at 10%. Mix of credit has to do with managing different types of credit responsibly, so having a mix of things like credit cards and loans. We don't typically recommend paying interest you don't have to pay. You can build credit for free by paying off that credit card in full, but there is a bit of a tiny bit of boost for having those different types of credit because you're showing management in different areas. And then that new credit piece really has to do with how often we apply for credit. So the idea here is to space out applications. They recommend limiting them to once every 6 months or 2 per year. So that way you're not applying to borrow money too often is the idea for new credit there. So spacing out those applications for new credit a bit. And noting that applications for new credit is like applying for a loan, applying for a credit card, while you checking your credit score will show in your report, but is not an application to borrow money. So that part will show in your report, but does not impact your score. There are a few other tips to help build strong credit that I want to share. It includes really making those payments on time. Emphasizing that is so key here because that, again, is the biggest part of your credit score. So make your payments, make them on time. That'll help boost your credit score quite a bit. Keeping that reported utilization low, again, under 30% is typically the threshold, but the lower the better. Folks that have the best credit scores tend to have about 1% of their available credit reported that they have utilized. And we can pay off those credit cards, again, in full, early, and build credit that way, and build it for free. Keeping that oldest card open is, again, a really key tip to help build out that credit card history, build your overall credit history. But that is something that if there are extenuating circumstances like high annual fees on that credit card may not be worth that. So using something like the int.com/your credit tool to use the simulator to see what would happen if I close this card, how would it impact my score? But typically speaking, keeping that credit history built out by keeping the oldest card open can really help. And one big thing I really want to emphasize here is that when you're applying for credit, when you're asking to borrow money, to apply with a clear plan for repayment. And so we're about to talk about some things to keep in mind when you are going into debt, when you're borrowing money, and when you want to think, is this something that's affordable to me? Does it make sense with my overall finances? Am I going to get approved for it? And so one of the first things we want to talk about is how to calculate your DTI. Your DTI is your debt to income ratio. It's looking at how much money you make versus how much money you owe that you've borrowed. And so, in order to calculate your DTI, you take your total monthly debt, so how much you owe per month that you've agreed to, and you divide it by your gross monthly income. This is your pre-tax, pre-other deduction income, that raw number that you might see up front. And you take that and times it by 100, and it equals your debt to income ratio. So it'll be a percentage that you get. Here in a second, I'm going to show a kind of a rough idea of what folks may recommend that you keep your DTI under. But one thing to note here is it's likely you may get approved to borrow more as far as a percentage with your DTI goes than is affordable to you in your unique situation. So this threshold that we're showing here is a threshold that financial experts recommend. It's a data point to use for information. But the biggest question you might want to ask yourself here when calculating DTI is how much can I afford to repay based on balancing my needs, balancing my wants, my savings goals, all of the different things that you may consider in your budget, asking yourself how much debt can I realistically take on. And so while the financial experts generally recommend under 36% as far as that DTI goes is affordable, that's a really general threshold, something where that might work for an average person, but in your unique scenario, is that percentage something that's going to work for you? So overall, it depends on your budget and really noting that those lenders may let you borrow more than you're comfortable paying back. But asking yourself, how much am I comfortable paying back? What would fit in my budget is really, really key. Another thing to consider when you are thinking about navigating debt overall is what are your values? When we talk about budgeting, we very often talk about including your values, so those things that are most important to you, into your overall financial plans and aligning your budget with that. You can also align the money you borrow or your debt with your values as well. So if one of your values is education, investing in your future, borrowing money for education to take care of that may be something you do. If a value you have is reliable transportation, like making sure you're able to get to work, to school reliably, confidently, safely, borrowing money for a car may be something you do. And if one of your values is safe housing, something that is stable, secure, a place that you can call home, borrowing money for a mortgage may also be something that you do. The idea here is to use debt to support your life, but not control it. Make sure when you are applying, it's aligned with your values, aligned with your goals, and something you have a plan to repay. When it is time to repay that money you borrow, there are many different strategies that financial experts may recommend. With these strategies, we're talking about scenarios where you're confident that you're able to pay back your debt without support from other people, that you're confident you're able to manage it yourself. In these scenarios, you're sure that you're able to make your minimum payments. You make note of those. You check your balance, how much you have left that you owe. You look at your interest rates, and you look at your term, so how long you're paying back that loan. And with these strategies, the idea here is to pick the one that you're going to stick to the most, that seems most interesting to you, that's going to work with how your brain works and how that scenario is for you. But there are different pros and cons of the different strategies we have up here when we're thinking about paying back debt. Again, with all of these, the idea is that you're able to make all your minimum payments, and the idea is also that you have some in your budget that you would like to put toward paying down debt faster. With the first strategy, you make all your minimum payments and then you work toward paying down the highest interest rate debt first. This strategy, while we have it called mathematical on the slide, is also known as the avalanche method. The idea is that you pay down high interest rate debt quickly and save money over time by cutting down on some of that interest that you would pay. So you order your debts based off highest interest rate to lowest interest rate and pay them down by highest interest rate debt first. The next one we have up here is known as the snowball method or the motivational method. The idea is to pay off your debts by smallest balance to largest balance. So you can cross off your smallest balance debts first, roll up those funds into the next smallest balance debt, so on and so forth until you've paid off all your debt. This can help improve motivation, build confidence faster. You have fewer debts to manage as you go up the list. And so a lot of folks may like that one because it's motivational. The last one up here to consider is to pay off your debts based off of your emotions surrounding them. So you would order your debts based off of the one that stresses you out the most versus the one that stresses you off the least, and work toward paying off the debt that stresses you off the most first. This might fit into the mathematical or motivational models, but it also might not. Maybe the one that has the highest balance or the longest term just might be the ones that stress you out the most. And so working to pay down those, get rid of the debt that you feel stressed out about can help bring relief and be the plan that you stick to. It's not that there's a right or wrong between these different debt repayment strategies. The idea is to figure out a plan to pay down your debt that's going to work for you, considering all your other financial considerations, and be something that works with the way you think about it. All of these scenarios, as I said, are scenarios that work when you are able to make your minimum payments and when you have room in your budget to pay down your debt faster. But those might not be scenarios for everyone. We're going to talk here in a second about some support programs and some ways to, like, organizations you can go to that can help if you find yourself overwhelmed by debt. But one thing we want to talk about first is things to watch out for when you are navigating borrowing money that could lead to really stressful debt scenarios. And so some of these include predatory lending practices. So payday loans might be an example of these ones that have astronomically high interest rates, but they are scenarios where folks may go to them to try to get help in the moment, but the interest rate as a consequence later makes that emergency or that scenario even more expensive than it needed to be. Minimum payment cycles are another. The last time when I talked about those strategies, we mentioned making sure you make all your minimum payments. But if that's the only payment you're making on something, especially like a credit card, that interest rate makes that debt grow and become even more unaffordable over time. So working to pay down, especially high interest rate debt, can be really key to that financial freedom you may be looking for. Buy now, pay later programs are also something you may want to watch out for. These are becoming increasingly more popular, and while they give access to items in the now with that payment plan over time, it's something where those little fees can add up rather quickly. And so being mindful of your overall financial plan, balancing things, asking yourself, is this something I really have the budget and the plan for, or is it something that is becoming overwhelming rather fast? And then overdraft fees and scenarios as well. So being mindful, what do I have the funds for? What really fits in my budget? Is this something that is helping me both in the now and long term, or is it just helping me in the now with future consequences that I might not be thinking of or that I might be not prioritizing in the moment? So a lot of these are designed to feel easy in the moment, but hurt that long-term financial health. So if you are in scenarios where you're looking to get through the now, we'll share some resources to help with that here in a second. Speaking of those resources, there are some programs out there that you might see that can help with when you're managing debt, when you're trying to navigate credit, etc. There are pros and cons of different programs. I'm going to speak more in depth about debt management plans and debt settlement programs here in a second, but I do want to share that we have a partnership with a debt management company called GreenPath Financial Wellness. The other thing you might see out there is things like debt resolution programs. These are typically not-for-profit debt settlement programs, and so they're ones where the fees for those programs may be less, and they tend to help folks in scenarios a little more regarding doing what's in your best interest. But those are some programs that you can check out and look into. And then credit repair programs, you may also see them out there, but a lot of times something like credit repair, what that product is really offering scoring is something that you may be able to do yourself using a tool like that credit partnership I mentioned, where you look at what you can do to improve your credit and follow the guidance of that, and that is a free tool. Or you can meet with our financial coaches, who I'll share information on with a second, who can also help work on your credit goals, again, for free. So you don't necessarily need to pay for that service. As I mentioned, I'll talk more in depth about management and settlement. Both of these are organizations that are meant to help people who are overwhelmed by their debt, but they work a little bit differently. Debt management companies are places where you go and say, "Hey, I'm overwhelmed by debt. I really need help. Can you help me manage my debt?" So they negotiate with your creditors, they continue your payment history, so they work out payment plans. They hopefully are able to get you reduced interest rates, which saves you money again over time and makes that debt a bit more affordable compared to trying to navigate that by yourself. But those lines for credit are closed and paid off through the process. So because of that, there's an initial hit to your credit score, but the idea is that you'll build back your credit score over time because you are making payments, and that's part of the plan. And as we talked about, payment history is the biggest part of your credit. One thing to note about these programs is they do have fees with debt management programs. The fees are set by the states. And so when you're looking into these programs, checking to see if those fees will make up for what you are saving by going through that management program, and that assurance that you will have your debt managed can be something to keep in mind when you're navigating that. The other one up here is debt settlement. The idea is that you're going to these organizations and you're saying, "I'm really overwhelmed by my debt. I would really like some help." And their idea is to settle for less than you originally owed, or less than due. And so their lawyers send cease and desist, say, "Hey, we're going into a period of negotiation. We're not paying right now." Those credit lines go to collections, which really drops your credit score because you don't make payments. And as we said, payment history is the biggest part of our credit score. It's also worth noting that in debt settlement, reduced debts are considered taxable income. So it impacts your credit score, it impacts your credit history, and it impacts your tax scenario. So there are some less than ideal consequences of debt settlement programs. And these are also programs where, as we said, they have those debt resolution programs that may be able to do this for fewer fees and maybe are typically in the better interest of somebody. But there are scenarios where settlement may be something that makes the most sense for somebody. We often recommend somebody look into a debt management program first because the impact to taxes and credit aren't as extreme. With that, we want to share a few tips to keep in mind when you're working toward navigating credit and debt. Step one is to really make sure you understand your scenario. So look at your credit score, review your report. Step two would be to work to stabilize by making on-time payments, covering those minimums, and trying to avoid unnecessary debt. Step three would be working on improving, so lowering that credit utilization, keeping accounts open, and building positive credit history. And step four would be to optimize, so to pay down high interest debt and use credit as a tool to reach your financial goals and take care of your financial health. I did mention we have some of those resources. That financial coaching is something that you can do one-on-one or as a family. It can help with budgeting, credit, savings, and debt, and it is open to everyone. You don't need to be a member with us to use this service. It's free, it's non-sales driven. If you are trying to navigate improving your credit or paying down debt, they can be extra helpful tools, especially as a first stop to get information, resources, and direction. The last thing I want to share with you all is that we are running a chance to win. This is a quarterly drawing. We draw one winner at the end of each quarter with a chance to win $50. If you fill out our survey on our financial education presentations, you can scan that QR code there or go to int.com/finedsurvey. The capitalizations are sensitive for that. I'm going to hang out for a second to answer any questions that may arise, but we so appreciate you all joining us today, especially for Financial Literacy Month with our series in April. And I hope you all learned something with Borrow with Confidence. We hope to see you at our next one, Save with Purpose. Thank you all. Bye. If there are no questions, I'm going to go ahead and end the webinar. Thank you, everyone.